GST 2.0 was supposed to be a big trigger for India's consumption story. Tax rates were cut across key categories from food and footwear to autos and wellness products. The market expected demand to pick up and consumption stocks to re-rate. But 2 months later, that rally is missing. Instead of surging, more than half of the consumption basket is still trading in the red. So why hasn't GST 2.0 lifted the sector yet? And when does the real upside begin? Let's break it down in markets this week. Despite high expectations, consumption stocks simply haven't reacted the way many predicted. Since September 3, when the finance minister announced the GST revamp, 14 of 30 major consumption stocks have fallen. Since implementation on 22nd September, the number has risen to 17 out of 30, still in the red. Top decliners include Dixon Technologies, Avenue Supermarts and Trent, down up to 15%. On the other side, Asian Paints, Titan and Hero MotoCorp have gained 11 to 16%. The sector is split and investors are waiting for clear signals. Analysts point to two short-term disruptions that are holding back a re-rating. Transitional challenges as the GST shift plays out, extended monsoon that has dragged Q2 earnings. According to Motilal Oswal, the consumer sector delivered only 5% year-on-year earnings growth in Q2 FY26. Staples demand held steady, but the GST transition slowed overall performance. While markets wait for earnings confirmation, there are signs of volume revival on the ground. Nomura data shows car prices dropped 6.8% month-on-month. Two-wheelers fell 4.5%. Electronics, clothing, footwear and food items saw broad-based price cuts of 0.1 to 0.8%. Lower prices are starting to filter into demand, even if stocks have not reflected that yet. Experts believe the real impact will show up in Q3 and Q4 of FY26. Once hard numbers come through, markets are expected to take notice. Additionally, FMCG could see support from softening commodity prices, tea, palm and coffee, a better monsoon lifting rural demand, recent personal income tax cuts and upcoming pay commission impact. However, mid and small cap consumption names may continue to lag because of liquidity pressure and a strong IPO market absorbing flows. So if analysts are right, the next 2 quarters will be decisive, when demand revival shows up clearly in the company results and eventually in stock prices. That's it for this episode. Don't forget to like, share and subscribe for more such incisive market insights.